This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 172 is brought to us by Bybit and the World Series of Trading. It is the largest trading contest in the world. It is not for everybody, but it is for some people. If you have an advantage, go and use it, because the prizes are absolutely insane. And if you're going to sign up, you may as well do it through my link, because you get a ton of great add-ons on top of your entry into the largest trading competition in the world. Go down to the description, go down to the show notes, hit the link to the Bybit blog. It tells you everything you need to know. The link for the contest is going to be in there as well. Get yourself signed up and enjoy all of the benefits Bybit gives you, because with Bybit, membership has its rewards. It is the 10-Minute Contrarian Podcast, and this episode is going to be like a companion episode to the one we just did. So if you have not listened to the episode called Rule of 72, what you may want to do is pause this and go back and listen to it. It was the episode right before this one. Shouldn't be hard to find, because that episode really is the backdrop for much of what we're going to be talking about all through the month of October 2024. But the main takeaway from that episode to you should have been the idea that percentage points, even one here, one there, they really, really make a difference, especially in the long term, because compound interest is magical. And compound interest can turn small things into very big things. I would always try to get this idea across to people on my trading material, because I said, okay, technical analysis is a distant third to money management and trading psychology. Because without money management and trading psychology, you're not going to be good at this at all, and you're just going to end up losing your money. So first things first. But then after that, yes, put a really good technical analysis algorithm together and spend as much time as you need making sure you have a good one, because percentage points really do matter. And every little 0.5%, 1% you can get over time is going to make a very big difference years down the road. This is very hard to explain to somebody who is really getting into the Forex game for the first time, because as we all did when we started this whole journey, we were not interested in, one little percentage point here, one over there, two over here. We were looking for much, much more than that, because we wanted to live off of the money we made trading, which I also had to tell people is not the best route to go. We'll touch on that in a moment. But the overall theme of this episode 172, is to illustrate some of the advantages that we have over your average person who gets into this investment game, or in a lot of cases allows somebody else to do it for them, when it comes to overall total return of their portfolio. We should all be getting much higher returns than your average person and your average firm. And this is really exciting, because we saw last episode, especially if you looked at that table, when you start consistently getting into the early to mid to even high teens, and you can sustain that year after year, things start getting really, really nice. Like almost too good to be true nice, but the numbers are the numbers. And if we put in a little bit of work and set up our strategy now, we can really, really start to get ahead of this. So let's take some time to illustrate the advantages we have over your average person. Let's just start with your average home trader. I've talked to these people all the time. As soon as they find out I'm in the financial space at all, they want to do nothing but talk my ear off about this one really, really great trade they're in. But I know almost for a fact that these people are not very good at investing. They have no guidance. There's psychology to investing as well. There's a lot of it. And there's a lot of money management to it as well. And if you understand this from a trading angle, you're going to be able to carry this over into investing as well. But as we know from the trading side, nobody has any money management or has their own psychology locked down. That's really important, because when you're talking about your nest egg, the emotions are really going to get into the way and make you do things you should not do. So I don't even want to spend a whole lot of time talking about home traders. I mean, that's what we are going to be eventually, but just know that we are not them in any way, shape, or form. Your average home trader is, best case scenario, they're underperforming. Worst case scenario, it's only a matter of time before they get murdered. They have probably benefited from the market we have had, the best market in the history of the world. But then these are also the people who, quote, lose everything when there's an economic downturn. They're like, I lost it all in the great crash of 2008, like it was the crash's fault and not theirs. Anyway, moving on. You also have your people who are retired or getting really close. And these people, as we said in the past, generally give their money to somebody else. They've already made their money. They're like, hey, just don't lose it. Give me a little something to live on. I'll add that to my pension, my Social Security, whatever. Or I'll just keep working, which a lot of people, in their older age do now. And that's all they want. Now, that's fine. I'm not saying these people are doing it wrong, but I will say these people are also getting their percentage points eaten alive by fees. If they had any idea how to do this themselves, and it's not super hard really, but they would simply add on multiple percentage points simply by not giving it away to somebody else. These financial institutions, especially the ones that deal with retirees, really, really get you on fees. And what's worse is a lot of times these funds, these firms, don't rotate into safer assets during downturns for a couple reasons. One, for gold, for example, they don't make any commission off of it. So they're never going to rotate you into gold unless they absolutely have to. And as gold holders, we're waiting on that day. But my mother's financial advisor, for example, she loves him, but he refused to give her any gold exposure because I can't even remember the reason he gave. It was a dumb reason. This is back when gold was at 1,700, and I'm like, all right, I see what's going on here. But a lot of times, too, what these companies will do is during economic downturns, they'll just sit back and do nothing because they know that even though they're going to take some drawdown, history says it's just a matter of time before everything goes back up again and then goes up higher. So like we talked about in last week's episode, you generally want to avoid years where you're taking negatives because that averages in to the overall return of what you're able to get. But a lot of these places just take those losses voluntarily when it doesn't have to be that way. Now, on the other side of the coin here, instead of playing super defense, you have hedge funds, which play super offense. But what's also unfortunate here is the majority of your hedge funds underperform. You always hear about the famous ones at the very top. Good luck even getting into those. The minimums are insane. But I did an episode way back on my old podcast saying how most hedge funds go under, because they do. I mean, the competition out there is insane. You have to end up doing things you wouldn't normally really do just to get that extra alpha. So instead of playing it too conservative like a lot of your retirement-focused firms do, you go the complete opposite direction out here and end up getting yourself wrecked. And so your average person, in terms of what they do with the money they're saving, will generally fall into one of these three categories. And the question is, can we do better than your average person? And what does that look like? So I can't exactly answer the second part, but I can certainly answer the first. And I think by simply doing a lot of the things that they don't do is going to do nothing but add on those sweet little percentage points over and over as time goes on. And how much of a difference can that make? I would say a pretty significant one, actually. So let's map this out a bit. Now, let's expand on something I was talking about just a little bit ago. During down times, during down markets, what do? Do you just sit there and take it? Well, that's not good, and you should not do that because, we're going year by year, and negative years average in to your overall total return in ways you don't want them to. So if you can just simply eliminate those negatives, this is a big difference. We here at the 10-Minute Contrarian podcast know exactly what to do during downtimes should they come. It's kind of our niche. Like we said before, do they rotate into gold? No. Do they look at things that actually go up in a down market, like oil stocks? No. Not usually. There could be some outliers out there that do this, but I haven't seen them. And what's worse, like I said before, a lot of them don't even rotate into cash because your broker can't make money off of that. Any one of these things would make a really big difference. But imagine if you were well versed in all three and took action appropriately. You can really win by not losing. And not even win by not losing, win by winning also. We're not talking about taking a zero here, even though taking a zero would be a big improvement. Not only can you gain all of those negative percentage points back and bring yourself to zero, you can start adding those percentage points on. Now, again, we're talking about in a down market, in a down year. But also given what we know now about just how important and how valuable every single little percentage point is, when you're eliminating negative ones and then adding on positive ones, that swing can be quite significant. And just the simple knowledge of knowing what to do in down markets compared to most people who either get run over or just sit there and eat the losses. I mean, that alone, I could stop the episode right now. And that alone is going to make a really huge difference to your year-over-year total return. But let's take it further. Now, speaking of dividends, and I said too before, we're not going to go super deep into dividends until it's time. I've kind of gone back on that a little bit because we're talking about them now. But there's a lot more to discuss, and hopefully I can manage to save a lot of those episodes for later. But while we're here, understand that when it comes to dividends, most firms don't really pay too much attention to stocks and vehicles which can give you higher than maybe 1 or 2 percentage points here or there, which is fine. They like dividends, but they want to keep it really safe. So they don't really explore options to where you can get higher dividends, maybe even in the 3 to 5 range, maybe even a little higher than that, without sacrificing growth. There's people out there who see, a 4% or a 5% or a 6% dividend, and alarm bells go off. I'm like, ooh, why are they doing that? That looks like a desperate move. Well, without getting too into it just yet, there's a lot of reasons why you would give a dividend back to your shareholders. One of them, and we should never ignore this, is that when it comes to a particular sector, a lot of home traders especially really can't discern much of a difference between company A and company B. So if company A is giving you a 2% dividend and company B is giving you a 4%, well then, what is your average person going to choose? Dividends are free money. So simply because a lot of these companies want to stay competitive, they will give you more. It doesn't mean the company's in trouble. It doesn't mean the company is desperate for shareholder money. And it doesn't mean these higher dividends are going to cripple what these companies are going to be able to do. Now, again, there are levels to this. Once you start getting into your really high dividends and your covered calls and your yield maxes and things like that, generally those vehicles have not outperformed anything in the long run. Those dividends are really, really alluring, and there might be some years where this thing just kills it. But overall, they have not outperformed really anything long term. So yes, should you generally avoid really high-yielding instruments when it comes to dividends? Yes. On the low end, might they be a bit too conservative, and could you do better? Also, yes. And a really simple, basic, broad-stroke knowledge of this can really go a long way. If you don't believe me, go back to that chart on the Rule of 72 and tell me what the difference is between a 2% return and a 4% return. Now, ever since I started talking about dividends, I've gotten this question a lot of times because people want to get started. They want a base knowledge of these things. And if I'm going to be a dick and not give it to you for a while, then people want material. So they're asking me, hey, can you recommend a good book on dividend investing? Now, I've read probably 3 or 4 at this point, and I can really just say, I'm going to give the same advice to you as I've given to them. It kind of doesn't matter. They're all pretty good. So I would go to Kindle or Google Play Books or wherever and see which books get really good ratings and buy one of those. You pretty much can't go wrong. A lot of them are not very expensive nowadays. And everybody who probably bought a book like this was in the same position you are now and just wanted to learn and have it easily explained to them. So if they gave it a good rating, then you will probably like the book as well. Now, the only advice I will give is do your best to maybe buy something written this decade, because the amount of options we have available to us has obviously gotten better over time. And I would say it's to your advantage to find a book which goes over these options as well. But I would say the sooner you get started, the better, because the advantages are very, very clear. Now, another thing your average person doesn't do is they all have cash. And cash often doesn't factor in to their total return. Now, it's quite debatable on whether cash should or shouldn't. Most people don't really count cash into their overall nest egg, but should they? It's a part of what you have, just like a home would be, just like an investment account would be. You can debate that back and forth all day. There probably is no right answer. However, when it comes to these percentage points, most people are getting absolutely no yield on their cash. It doesn't have to be this way. We've talked about it here many times. If you want to know more, go back to my episode called FYPM and go back to my episode called Financial Preppers Checklist 2, the number 2. Both of these episodes talk about passives, getting those sweet, low-risk percentage points on your cash as opposed to doing nothing and allowing inflation to eat it away. Again, the swing between the negative and the positive can be pretty wide. There can be a lot of percentage points in between those two numbers simply by taking a bit of action. It's not like that cash is lost forever. It's your money. You can take it out at any time. But while it's sitting there, let it work for you. This is one of the biggest, the most classic differences between rich people and poor people. And nowadays, poor people can do the same things rich people can do. Maybe not poor, but if anybody goes to their investment platforms right now, they offer you ways to get into things like T-bills. So if you got cash just sitting there in your account, you can start earning interest on it. I know those interest rates are dropping, but it doesn't matter. Until they drop to zero, you're going to be getting something back on your money, and you can take it out at any time. As we've spoken about before, there are bank accounts in certain parts of the world that will give you money just for having it sit there. I have a bank account in Panama that just gives you 2.5% by having your money squat in a savings account. And 2.5% doesn't seem like a lot to your average person, but I'm super excited about it because that's 2.5 percentage points I'm getting on my money that I was not getting in the past. And hopefully last week's episode illustrated just what a difference these percentage points make. But as we know also, you can do this on the blockchain as well. Now, are there added risks to this? Absolutely. But like anything, we take risks here because we are not risk averse. But at the same time, how do we mitigate those risks? If you can play both games, and we all know how to do that here, it can be quite advantageous. So one of the things that mitigate risk, in my opinion, is just the fact that we are in DeFi 2.0 as opposed to 1.0. 1.0 really was the Wild West. People were getting 20, 30% returns on their stable coins. I was one of those people. I was using something called Bancor. The ticker symbol for their token is BNT. And through Tether, USDC, and DAI, you were able to get 20 to 30% returns on it. And I even knew this wasn't going to be long-term sustainable. So I didn't put a ton of cash over there, but the cash I had over there was generating exactly what it's supposed to. And you were getting BNT tokens, but this was also when the market was going up. So those tokens were going up, but I didn't really care. I was mostly flipping those tokens into more stable coins, because why get greedy when you're already getting a 20 to 30% return on your cash? Now, this is all kind of irrelevant now because it wasn't sustainable, but the lesson I want to give out here is, and we've talked about this on the program as well, is I was able to get out of Bancor before it collapsed, because where there is smoke, there is often fire. And the good thing about the blockchain is if you need to bail for any reason, as long as you do it before the proverbial poop hits the proverbial fan, you should be able to do it almost instantly. Nowadays, I know a handful of people who are using a service like Nexo and getting 8% back. which seems a bit high also to me. But these people also know where there is smoke, there is fire. If anything starts to get a little shaky with Nexo, they know just to simply take their money off the table and wait until the smoke either blows over and then they re-enter, or everything collapses and they simply move that money over to something else. It's not difficult. It doesn't have to be super scary. And there are plenty of services out there now who will give you still nice but lower returns than 8%, and are likely also doing it in a very reasonable and safe way. And if this all sounds too risky for you because it's all still kind of new and not fully developed yet, okay, that's fine. You don't have to do it. But two things. One, is your average person utilizing these options? Absolutely not. They're only available to those who know and understand it. And two, blockchain is not your only option to make money on your cash, as we've just spoken about. There are many ways. The only difference is, are you going to utilize them like rich people do or not utilize them like everybody else does? I've made my decision on that because even if those yields are low, percentage points matter, and they matter a lot. Along those same lines, your average person doesn't trade, and if they do it poorly. They're not making plus money year after year trading. A lot of you guys are. I'm known for not touching the money that I do make year after year and just rolling it over, even though there are times where I'd like to pull that money out and use it, but I don't. Why? Because of compounding. Compounding is magic. Percentage points matter. And if you know what you're doing and you have your psychology locked down and you are trading Forex and you are trading metals and you are trading crypto, you can just go right ahead and add these percentage points on. Now, let's say you make a 10% profit every year in trading. You're not adding 10% on to everything because I would hope at least you're not trading everything you have. You're investing some of that money too. But you can take that 10% and divide it by whatever amount of money you have allocated to trading compared to investing, and you can simply add those percentage points on. So those were a lot of things. Should we add one more? A really big one? I think we can. Your average person does not invest in crypto. And thank God for crypto and the absolute unicorn outsized gains that market has given us over the past 10 years. We will probably never see anything like it ever again. And there is still a lot of upside to be had. But let's break it down into percentages here. I can't speak for you, but you guys know what I do because I put it all out right here on the podcast and on Twitter. You can follow me on Twitter, by the way. Link is down below in the show notes as well. But you know what we do here. Apart from things like Bitcoin or Litecoin, which I just want to sit on forever, I will invest into a token. And if it right around triples in value, I will take half off the table into cash, into a profit, and then move my stop loss to break even. And if price goes back down and hits that break even, which it has several times, you guys were all around for this, then, unfortunately, I did not make a 300% return on that investment, but I did make a 150% return on that investment, and usually in a relatively short amount of time. So what does something like that do to your portfolio? What does that do to your total return? Simply a situation like that where it didn't even moon. We just took our 3x, cut it in half, and moved on. Now there's going to be times where something does moon and you get that situation that we're all, pulling for. And we were able to get a really big return on that crypto while completely exiting out of our position. That's going to happen sometimes too. And we particularly invest in asymmetrical things. So this should be happening to us quite a bit. And that's going to be a really big percentage. Now, one thing you want to do here is don't take that percentage and automatically carry it over into the total return on your account. Because sometimes you might be holding these tokens for years. And however many years you've been holding it, you have to take that number and divide it into the total return of your investment when you closed it out. But even if you do that, that return is still going to be really, really high. Your average person is not adding on returns of 500,000 2,000, 3,000%, and factoring that into their total return. It's just not something they do. But it is something we do. And yes, every once in a while we get wrecked, and you got to factor those negatives in. But all told, if you're in the crypto market and you're doing it intelligently like we are, you're going to take a lot less negatives than most people are. And unlike your average person, you get to add those completely outsized returns to the overall total return of your portfolio. So when you go back and look at that table for the rule of 72, and you start looking at those higher numbers, look, I'm not here to overpromise anything. I'm not somebody who overpromises. I'm pretty much the opposite of that. I was the guy who came into the Forex market and said, look, keep your expectations realistic for Christ's sakes. Let's approach this like grown-ups. And I am not a licensed financial advisor. Do not do anything I say. However, if you simply look at the numbers and the percentage points which are available to us, should we choose to have them, compared to what your average investor does, I think it's pretty obvious that the numbers on the higher end of that table, and perhaps even beyond, are not out of our reach. It's not hype. It's math. Do the math yourself. Numbers don't lie. But to your average investor and your big name firm out there, this is going to seem absolutely crazy. But we are not crazy. In my opinion, we're just better.